All right, let's get right into it. We're going to tackle a huge question today, one that really gets to the core of what it means to build wealth. Are you actually investing, or are you just kind of hoping for the best? Because let me tell you, hope is not a strategy. The real difference between the two, it all starts with how you look at the market. So what is it to you? Is the stock market a collection of real operating businesses, or is it just a giant casino? Seriously, think about it. How you answer that question changes everything. It's the fundamental difference between having a real strategy and just placing a bet. So, to help us turn that hope into a concrete strategy, we're going to walk through 4 key principles from 2 absolute legends, Graham and Bogle. First, we'll nail down the difference between investing and speculating. Then, we'll talk about your best defense, the margin of safety. After that, the hidden enemy, cost. And finally, we'll look at the incredible power of keeping things simple. All right, section 1. Let's talk strategy versus pure guesswork. Look, before you can even think about building an investment strategy, you have to know what an investment actually is. Getting this right is the bedrock for everything else we're going to talk about. You know, Benjamin Graham laid this out perfectly, and his definition just draws this crystal clear line in the sand. An investment has 3 non-negotiable parts. 1, you've done your homework. That's the thorough analysis. 2, you're confident you won't lose your initial capital, the safety of principal. And 3, you expect a reasonable profit, an adequate return. If you're missing even one of those, well, you're not investing anymore. You're speculating. You're just rolling the dice, hoping the price goes up. And this right here, this is the essential mindset shift you have to make. A stock isn't just a flickering symbol on a screen. No, it's a tiny piece of ownership in a real, living, breathing business. That business has a real value based on its stuff, its assets, its earnings. The share price, that's just what the market feels like paying for it today. The investor owns the business. The speculator is just betting on the market's mood. Okay, so if you're going to be a business owner and not a gambler, how do you protect yourself? I mean, what happens when you're wrong? That brings us to our second huge principle, the margin of safety. You can think of this as your ultimate defense system. It's a shock absorber for when your analysis isn't perfect or, frankly, when the market just goes completely nuts. Now, to build that defense, you first need a benchmark. You need to know what a business is actually worth. That's its intrinsic value. And this isn't a guess. It's a calculated estimate based on real-world stuff, like how much cash the company makes, what its assets are, how much debt it has. It's the true value of the business, totally separate from the day-to-day noise of its stock price. So your margin of safety? It's simply the discount. It's the gap between that real intrinsic value and the price you actually pay for the stock. So, if your analysis says a business is worth $100 a share, you don't go buy it at 99. No way. You wait. You wait until you can buy it for, say, 60 bucks. That $40 difference, that's your margin of safety. It's your buffer. It's what saves you if you made a mistake or if the world just throws you a curveball. So you're probably wondering, okay, where do these incredible discounts come from? Well, Graham had this great metaphor. He saw the market as a pendulum, just swinging back and forth, always going from crazy optimism, where stocks get way too expensive, to totally irrational pessimism, where they get dirt cheap. An intelligent investor doesn't ride the pendulum, they use it. Those wild swings are what create the opportunities to buy that $100 business for 60 bucks. And this is the strategy in action. It's so simple to say, but so hard to do. It means you have to be willing to step up and buy when everyone else is terrified and running for the exits. And you have to be willing to sell when everyone else is euphoric and thinks things can only go up. You're basically acting as the calm, rational adult in a room full of emotional people. That's how you capture a margin of safety. All right, on to section 3. So far, we've talked strategy. But you know what? There's a silent killer that can wreck all your brilliant plans, and that's cost. John Bogle, the founder of Vanguard, basically built his entire philosophy around defeating this one enemy, what he called the relentless arithmetic of cost. It is one of the biggest, most overlooked threats to your long-term wealth. Bogle puts this so bluntly. Costs matter. A lot. Even a 1% fee, which sounds tiny, right, has a massive, massive impact. Think about it. If the market gives you a 10% return, that 1% fee doesn't just lower your return to 9%. No, it eats a full 10% of your profit. Gone. And it does that every single year. And you might think, oh, costs only matter when I'm making money. But nope, it's actually the other way around. This chart shows a period when the market was actually down. Now, the low-cost funds, yeah, they still lost money. But the high-cost funds lost way more. And that gap between them, it has nothing to do with stock picking or brilliant strategy. It is 100% due to fees. Keeping your costs low means you lose less when times are bad, and that is a huge, huge advantage. Over the long haul, this little drag on your return snowballs into something Bogle famously called the tyranny of compounding costs. You see? While your money is trying to compound and grow, the fees you're paying are compounding right alongside it. It becomes this brutal battle for that magical growth. And with high costs, a huge chunk of it ends up in somebody else's pocket, not yours. So just how bad is this tyranny? Get ready for this. Bogle's research showed that over a typical 15-year stretch, the average managed fund gave up nearly a third of the market's total growth just to costs. 30%, poof, gone. Wealth that should have been yours just vanished into fees. This proves that controlling costs isn't some minor detail. It's one of the most critical parts of any winning strategy. Okay, this brings us to our final and maybe most powerful section of all. We live in a world that's just obsessed with complexity, with secret formulas, with finding an edge. But what if the best strategy is actually the simplest one? What if trying to be clever and outsmart the market is, for most people, a losing game? Which, of course, leads us to the ultimate question. After all of this, after all the analysis, what is the secret to success in investing? And the answer from Bogle himself is, well, it's a beautiful paradox. The secret to investing is that there is no secret. It's not about some magic formula or some hidden piece of information nobody else has. Success comes from just relentlessly, boringly applying the simple, powerful principles we've been talking about. And look, if you think the secret is just to hire a professional to beat the market for you, well, the evidence is just brutal. This chart shows 25 years of performance. It pits professional fund managers against a simple, broad market index. And the results are staggering. The vast majority of them, 175 out of 207, failed to win. These are the supposed pros, with armies of analysts, and they still couldn't beat the market, mostly because of the drag of their own fees and constant trading. So if being clever doesn't work, what's the alternative? Well, Bogle boils it all down to these 4 incredibly simple but incredibly powerful rules. Number 1, you have to invest. Sitting on the sidelines in cash is the biggest risk of all. 2, time is your best friend. Let that compounding do its magic for as long as possible. 3, impulse is your worst enemy. Your emotions will destroy your returns. And finally, number 4, keep it simple. And that brings us to the last killer idea. The goal isn't to spend all your time and energy trying to find that one magical needle in the haystack. The goal is just to buy the entire haystack. That's the beautiful logic of a low-cost total market index fund. You stop playing the game of trying to beat the market, a game most people lose, and you start playing the game of simply capturing the market's return. And that right there is how you stop hoping and start investing.